Hello and welcome back to the Unlearned Investor. I am your host, a data analyst, an average person with no finance degree, no advisor license, and absolutely no interest in making this more complicated than it needs to be. Before we get into today's episode, the usual reminder: I am not a financial advisor. Nothing I say today is financial advice. This is purely for educational purposes. Please do your own research and before making any investment decisions, speak with a certified financial professional. Always. Alright, let's talk. In episode 3, we drew a very clear line between assets and liabilities. We talked about what feeds you and what eats you. Assets put money in your pocket, liabilities take money out. Simple as that. But here's the question that most personal finance articles quietly skip past. Okay, fine, I understand the difference, but how do I actually buy these things? Where do I go? What do I do? That's what today is about. Episode 4: How to actually invest in assets. Let's start with the most common excuse I hear, and I want to address it head on because I think it holds a lot of people back. I don't have that kind of money to invest. Meet Ronald Read. Ronald Read was born in 1921 in a small farming town in Vermont in the United States. He was the first person in his family to finish high school. After serving in World War II, he spent 25 years pumping gas at a service station, then 17 more years working part-time as a janitor at a JC Penney department store. He drove a second-hand Toyota. He wore second-hand clothes. He cut his own firewood well into his 90s. When Ronald Read died in 2014, his family discovered something that shocked everyone. He had quietly built an investment portfolio worth roughly $8 million across 95 different companies. A janitor, no finance degree, a salary most people would call modest at best, $8 million, built by buying a few shares at a time, holding them for decades, and never panicking. Now, I want to address another version of this excuse, the "I'm not rich enough to invest" version, and this one deserves an honest answer. Warren Buffett, one of the greatest investors in history, calls it the ovarian lottery, and it's a brilliant concept. The single biggest factor in where you end up financially is not your intelligence, not your effort, it's where, when, and to whom you happen to be born. A child born in a rural area to uneducated parents simply does not have the same access to financial markets as a child born in a major city. So, yes, your starting line is partly set by luck. Nobody chooses their birth. That is real, and it is unfair. But here is the thing: the lottery only sets the starting position, it does not pick the finish line. Ronald Read started with small amounts for decades, and the math eventually did the rest. So, with that out of the way, let's walk through the main asset classes and how you actually get into them. First up, cash in the bank. Now, cash is not a bad asset. Let me be very clear about that. Cash in the bank is the bullets in your investment gun. Without cash on hand, you cannot buy anything. When the market crashes, and it will crash, it always does, the people who can act are the people who have cash ready. Every opportunity that ever shows up requires cash on standby. Cash is power in negotiation. Sellers move when buyers have ready money. But here is the problem. For a long time, people built their entire retirement plan around saving cash and living off the interest. And that worked until roughly the 1980s and 90s because of something called a defined benefit pension. That's just a fancy term for a pension that guaranteed you a fixed monthly payment for life, no matter what happened in the markets. That world is gone. Today, almost every pension system in the world has shifted to market linked products. In the US, it's the 401k. In India, it's the National Pension System or NPS. The safety net that used to exist, where the government or your employer guaranteed your retirement income, has quietly been handed back to you. So, cash alone is not a retirement plan, it's a starting point, an essential one, but only a starting point. Next up, bonds. A bond is simply a loan you make. to a government, a company, or a bank. In return, they promise to pay you regular interest and return your original amount at the end of the agreed period. Think of it this way. Imagine your friend asks you for 50,000 rupees or $500, whatever works for you. He says he'll pay you back in 5 years with interest. That is essentially what a bond is. You are the lender. The government or company is the borrower. Now, bonds sit one step above cash on the risk ladder. They are slightly riskier than money sitting in your bank account, but they reward you with meaningfully higher income. The technical word for that income is yield. Yield just means the interest you earn on a bond. Nothing more complicated than that. Government bonds are the safest. A stable government is unlikely to simply stop paying its debts. Lower risk, lower interest. Corporate bonds, bonds issued by private companies, pay higher interest. Why? Because companies can go bankrupt. The riskier the company, the higher the interest they have to offer just to convince anyone to lend to them. So before you lend your money to any private company through a bond, the most important question is simple. How reliable is the borrower? Is this company healthy? Do independent credit rating agencies, which are basically companies whose entire job is to grade how trustworthy a borrower is, give them a good score? We'll do a full deep dive on bonds in a future episode, but that's the foundation. Third, gold. When most people hear gold, they think of jewelry. And jewelry is a lovely thing, but jewelry is a hybrid of asset and consumption. You are paying for the design, the making charges, and the emotional value attached to it, and none of that comes back when you try to sell it. If you want gold purely as an investment, as something that holds value and protects you from inflation, there are two clean options. The first is a gold ETF. ETF stands for Exchange Traded Fund. Think of it like a basket of something, in this case, gold, that you can buy and sell on the stock exchange just like a regular share. You don't need to store it. No locker fees, no purity headaches, no making charges. You just own your share of gold digitally. The second option is physical gold, coins or bars, only if you genuinely want something you can hold. If you go this route, buy from a reputable bank or a verified dealer and keep the receipts. Fourth, real estate. Real estate is the most emotional asset class on this list, and honestly, it is also the most common lottery win people can get in their lives. Inheriting a piece of land or property can completely change a family's financial story. But real estate is also the most illiquid asset on this list. Illiquid meaning you cannot quickly convert it into cash. You cannot sell a house in a day, and it is the most expensive to enter, and it is the one most likely to trap people in the gap between owning something and actually profiting from it. There are two paths. The traditional path, you buy a property, rent it out, manage tenants, handle repairs, deal with vacancies. The returns, done well, can be excellent, but the time it takes, what I'd call the time tax, is very real. And remember, a mortgage eats you every single month until you finish the loan. The asset only starts truly feeding you once the loan is gone. The modern path is something called a REIT, that stands for Real Estate Investment Trust. Think of it as a mutual fund, a pooled investment, but instead of owning stocks, the trust owns a portfolio of commercial properties like office buildings, malls, or warehouses. You buy units of the REIT on the stock exchange, just like buying a share, and in return, you receive a cut of the rent collected, paid to you as dividends. You get real estate exposure without becoming a landlord. And finally, the two asset classes with no ceiling: intellectual property and owning a business. Here is something worth sitting with for a moment. There is a hard ceiling on how much you can save. No matter how high your salary climbs, the maximum you can put away is whatever is left after life takes its cut. Taxes, rent, food, school fees, life always takes its cut first. But intellectual property and business ownership break that ceiling entirely. They are the only two asset classes on this list that open the door to unlimited income. Intellectual property is something you create: a book, an online course, a podcast, a YouTube channel, a patent. The investment is not money, it is time, skill, and consistency. Most IP earns nothing. Let's be honest about that. But the few that work, they compound in a beautiful way. A book written once can sell for a decade. A course recorded once can earn while you sleep. Owning a business is the bigger bet. Roughly half of small businesses fail within 5 years. That is a real number. The ones that survive, however, can outearn every other asset on this list combined. Both of these are build assets, not buy assets. You cannot simply click a button and own them. They demand far more than money, but they are the only two doors on this entire list with no ceiling on the other side. Now, you may have noticed I deliberately skipped one very important asset class today: stocks. They deserve their own episode entirely. In episode 5, we are going to do a proper deep dive into investing in stocks: what they are, how they work, and how someone like me, someone like you, actually gets started. A quick reminder before I let you go: I am not a financial advisor. Everything you heard today is for educational purposes only. Please do your own research. And before making any investment decisions, speak with a certified financial professional. The disclaimer is not just a legal formality, it genuinely matters. If you found this useful, follow The Unlearned Investor on Spotify. And if you want to read the full articles with all the details, links, and references, head over to unlearnedinvestor.substack.com. It's free, it's honest, and it's written for people exactly like you and me. Until then, see you and take care. Signing off, The Unlearned Investor.